Afternoon, folks. Welcome to this edition of Risk Management webinar for Saturday, October 26th, 2012. My name is Mike Lim, and I'm the co-founder of Equity Sense together with Gavin Martinson. And just to give you guys a little bit more information about what we do at Equity Sense, we deal a lot into the world of stocks, options, futures, and currencies. We provide daily commentaries for from traders' perspectives, and provide unusual market activity data for unusual options buying and any big lots and whatnot. So we provide your daily commentaries, daily briefs, pre-market, during, and also post-market. At this point, we've found that we, so far, with our live audio service and our live news services as well, we provide one of the cheapest services, if not the cheapest, at this point in the web right now, considering most other trading and advisory services companies are charging north of $100 to $200 per month. So definitely check us out. Go to our website at www.equitysense.com. So just moving on. Risk management, that's what we'll be talking about today. What is risk management? And just to give you a quick outline of what we'll discuss, we'll talk about what risk management is, how to evaluate your risk thinking in terms of risk and reward, mental conditioning, trading discipline, and of course, the Q&A period will probably be gone on this part because this is a recorded webinar at this point for those people who didn't or weren't able to make it last Saturday. So risk management, the long-winded definition according to Investopedia, is just the analysis and acceptance of mitigation of uncertainty in investment and decision making. Essentially, risk management occurs anytime an investor or fund manager analyzes and attempts to quantify the potential for losses in an investment and takes appropriate action to lower that loss. In essence, traders have to be extremely good risk managers because what we're trading carries a lot of risk. As traders, our risk is continually being modified every single minute, every hour that we hold our positions as traders. And the same thing goes with investors. The only difference is that investors have a longer time frame to give or allow the trade or investment to pan out. So how do you define your risk? When you're trading, you have to define your risk. You have to define your risk in terms of how it pertains to your trades and investments. You have to define it in terms of how much dollar loss, are you willing to take on your investment. As well, you have to also take into account what your investment and trading time frame is. And what this means is that how long you plan to hold that trade for or investment for. So you have to factor all of those in before entering into any investments or any trades. So risk management is all about managing your psychology and your mentality when it comes to investing. First of all, we take a step back and think, why do we even invest or trade in the first place? At this point, capital markets, financial markets, are the single best place to get money back from investing capital. Nowhere else on the planet is there a legal and fastest way to make money with absolutely zero capital cost. Most businesses, if you open a small business right now, you'd have to go and get certified, get the right business licenses, as well as maybe you might even get put initial capital outlay to make your business work. Whereas with investments, there are literally zero barriers to entry. So why do we invest and trade? You have to understand the reasons why you're even here in the first place. You have to be realistic to yourself. Define your goals as completely as possible. And you have to estimate the timelines to accomplish your goals. So that's one way to think about why we even invest in the first place. And definitely, as with any investments, anything to deal with money, there's always a risk. And this is where risk management is extremely important for a trader. Much of investing and trading is all about psychology, your personality, managing your personality and your mentality. You have to know yourself, your tolerance to risk before you even jump into investing and trading. And third, you always have to remind yourself why you're even in the capital markets in the first place. If you're not comfortable investing and having losses, maybe this market or avenue is not for you. Maybe you prefer putting your money in a savings account in a bank. However, with most central banks around the globe putting in a lot of stimulus packages, they're effectively reducing the amount of return you're getting from your savings account. In the US, for example, it's the best case. With almost zero interest rates, you are getting almost close to zero and actually yielding almost negative return on your investments, on your savings. Especially with the Fed having a 2% inflation target, you're literally losing 1.75% of your investment to inflation. So this recommended exposure, it's a guide, but it's not set in stone. So how we view this is that how you would try to diversify your holdings as an individual, as a trader. So we recommend 60% for cash, 20% for cash, 60% for trading, 10% for bonds, and then 10% for money market funds. 60% for trading can mean any kind of trading vehicle you're in right now. The rule of 1%. We practice this extensively, between 1 to 3%. In trading during a day trade, we never allow our losses to go 1%, over 1% of our account. But this comes with some judgment in terms of how big your account is. So just an example, if you have a $10,000 account, never allow a daily loss of unrealized loss of greater than $100. So this is just an example. If you bought 610 puts of Apple for $1 a contract, and then say, that put went to 0.05, so 5 cents, you're going to have to really be close to taking a loss there. And of course, an advice on this one, if you're having a very terrible day, you should learn to stop trading that day and rest and relax and reevaluate how your trade went wrong. Just an example of how it could be if you're trading from 609 to 600, and if you didn't take a loss if ever you were long. This went further down to 590, right? And then who knows if it actually went back. In this case, it actually went back and reverted back to 610, but oftentimes we've seen Apple go down to $20 and never recover. So, when you're trading, think of it in terms of risk reward. We practice the 1 to 1.5 risk, where we spend $100 and make $150. So always have a strategy when you're going into a trade. It's important. If you don't have an exit strategy, don't trade. Mental conditioning. You have to understand how your mind works, and in terms of how you accept the risk that you're allowing to be in your system with trading. So trading is truly a struggle within your own psyche. And to do a proper trade, you must do a lot of learning. You must know yourself very well and know your limits and comfort levels. Trading discipline is the hardest thing to ever master for new and seasoned traders alike. Sometimes the most profitable thing to do is actually take a loss, because what if that loss spirals into a bigger loss later on? The do's, of course, define your risk reward. Set your limits, create your plan, execute your plan, and stick to it. Do not deviate. Have the courage to take a loss when the trade goes beyond your risk limit. Do not hope. Never ever hope in trading. Do not ever revenge trade. Do not get overconfident. It's good to be confident, but do not get cocky. Do not over-allocate your existing resources. Do not overtrade as well. And of course, never ever trade on emotion. In summary, risk management is managing yourself. It's difficult because you have to change what you're programmed to do. As human beings, we are all hardwired to be optimistic. There is no place to hope in trading. It's just setups and trading. That's it. You find your setup and you execute. That's really it. Read a book on risk management. The Disciplined Trader is the best resource I can definitely give you. And of course, you can always talk to us and become our client. Thank you for coming today, and we hope you've had a wonderful weekend. And definitely check out our website. And this has been Mike Lim, co-founder of Equity Sense. Thank you.